Dr. David Clark.
This issue is one that we debated at length in Select Committee, although it was some time ago, and I look across and recall Mr Bennett from the other side of the House there participating in this lively discussion in Select Committee. Other members here will think back and remember the interesting discussions we had. If a bank collapses, covered bonds have a higher priority over other lenders to banks, including the ordinary mums and dads. Now, there is no doubt that it's desirable to have some legislation in this area, and it seems a good idea to have an instrument that is protected from runs on banks, from other unforeseen financial situations, in order to attract a certain kind of lending at a premium. And having a covered bond is a mechanism that's used around the world to provide some financial security to banks and to other to other lenders. And we know that $6 billion worth of bonds have been issued over 2 years without any regulatory oversight. So it's clearly an area that needs to be addressed, and so it is good that it's timely, and it's timely to do so. Our question on this side of the House is as to whether the percentage of a bank's assets that can be placed in this position is too high. It's possible that the 10% limit is too high. And we looked at other examples overseas, and we found that in Australia it was lower, I think around the 8% mark from memory, and in Canada as low as 4%. And so we asked whether the big end of town needed this much protection, and whether in fact that level could be set lower. Those who were pushing the case seemed determined that it should be higher, and on this side of the House that left us a little bit uncomfortable. So we're really arguing about where the line should be cut, where it should be drawn. We on this side of the House are very concerned about small business owners, about mum and dad New Zealanders who take out a mortgage to start a business, those who are putting their shoulder to the wheel, who are taking the risks and who are borrowing money, and having them further down the list of people who are able to access capital in the case of a collapse seems an injustice. So we don't believe that too much of this covered bond lending should be happening, and we would have less of it. And we think of the recent example, not so recent now, but not so long ago, of Mainzeal, and the way in which individual contractors and small business folk missed out on getting their money, and worse than that, getting their tools back. And so Labor, of course, is proposing solutions in that area to make sure that subcontractors are looked after, the lifeblood of our economy, those who go to work every day, their interests are looked after, and that unfortunately doesn't seem to be a priority for the national government. They are more interested in making sure that the interests of big business are protected. And I could digress into Chorus and Sky City Casino deal and Rio Tinto as other examples of that. But I think we're better to focus on the particular issue of covered bonds, and quite where that line should be drawn. Mr Speaker, Labor will be supporting this bill, I have to say, despite our reservations. We do, and that is primarily because we think there needs to be a regulatory framework, and we're actually arguing, as I said at the beginning, about exactly and precisely where that line should be drawn. And the lack of a legislative framework has, we think, put New Zealand issuers at a disadvantage. At least there's with the regulatory certainty in Australia for those who are seeking to lend. There is some certainty to the people they're lending to, and as we know, in the world of business, often regulatory certainty is more important than other factors. Businesses like to know the risks that they're dealing with and to take their chances, develop a strategy around those risks. I think back, for a parallel example, to the emissions trading scheme, and I had the privilege of working on that legislation as an official many years ago, and when I contacted, for example, the oil companies, I had oil companies saying to me, we will scream if you put this legislation through, but we'll scream quietly if we know what it is. and we know the detail of it. However, if, Mr Chair,
Dr. David Clark.
however, if the rules are not clear, if the legislation is too harsh, if it comes too soon and too fast, we will scream loudly. And they are representing their interests, their clients and their profits, but they're also, like any business, looking to the future and saying we can plan if we know what the rules are. We can plan our arrangements, we can work out how we're going to structure our debt, we can plan as to which areas of industry we go into, whether we move toward renewables. We know BP had a brand that was about the future, a sustainable future, called into question by more recent events, but they made choices about where they were going to put their business interests, and that is around regulatory certainty. And certainly in New Zealand, one of the discussions we have in this Parliament often is around regulatory certainty and the ability to attract capital to our businesses here, not just overseas capital, but New Zealand capital. There are some significant New Zealand companies that want regulatory certainty here, and otherwise they will invest their money offshore. So that's why we will be supporting this bill. We do think that limit is a little too high and panders to the big end of town, that makes sure that the big institutional lenders, creditors and so on are protected, rather than looking to look out for the interests of those who are starting up, those who are literally risking the shirt off their back. We see the pattern there in the government's other behaviour, but we appreciate the need for a regulatory framework. There are, of course, other areas where we would like to see the government provide greater regulatory certainty in the interests of the financial well-being of New Zealand long term. And here we're talking about savings and savings at risk. In the KiwiSaver arena, we would like to see universal KiwiSaver, so that there's actually a greater depth of savings in New Zealand, a deeper pool from which businesses can lend. And we think of the Australian scheme, which came in shortly before the national government in the early 80s canned the scheme we had here. They now have about 1.6 trillion in their retirement savings scheme, and that is available capital. And so that is good for small business in New Zealand. If you want to start a small business, you're handing around the hat to your family members. In Australia, there is a lot of capital, and a lot of it's sticky capital that stays close by, that is available for good ideas, that pursues good ideas and ensures growth in their economy. So these are issues of savings. They're issues of how we protect lenders, whether we can attract good credit from overseas, and they're important issues for our country. There is, of course, plenty of others. There's the capital gains tax that we'd like to introduce, which we think would send money towards the productive sector again in New Zealand. And all of these things actually reduce the risks that we're trying to cut off here. When you have an economy that is prospering, when it's got a balance of trade that's under control, a rebalanced economy, there are fewer risks in it. It's more attractive for investors over time because they see its health. And it was very disappointing to see our economy downgraded under this government's last term, because essentially it didn't have the vision, it wasn't projecting the right kinds of figures in the period to come that would give the international ratings agencies confidence. And I guess that's because this government has run deficits consistently, where the last Labor government ran 9 years of surpluses. And Michael Cullen was certainly a strong hand on the tiller. Our economy was running strongly, but under this government it has lacked a certain amount of vision. It has lacked the ability to convince those ratings agencies that we have a long-term plan for our economy, that it's secure, that it's a good place to invest in the same way that the previous Labor government has. This government has a poor record on the economy, the worst economic record of any government in the last 50 years in New Zealand, whereas the Labor government, certainly with introducing KiwiBank, KiwiSaver and other measures, pushed us towards more secure savings that will benefit small businesses in our economy, the type of issue that we are dealing with here. So the legislation itself has three main elements. A requirement that the covered bonds issued in New Zealand by banks be registered, subject to meeting registration requirements. So that's a technical expectation. It enables monitoring. It makes sure that this doesn't get out of hand. Independent monitoring of covered pools by an asset monitor, and provision to amend the Act in the Companies Act. Mr. Chair.
The Honourable Clayton Cosgrove.
Mr. Chairman, like my colleague,